US inflation comes in below expectations. Let's have a look at the initial reaction from markets. So US inflation reported yesterday demonstrated that at headline level, inflation actually cooled over the year to 2.8% in February, down from 3% in January. The result was marginally below what was actually expected. If we look at the components within this, you saw lower energy prices, which were quite a big part of this. Petrol and gas prices were down between 3 and 5%. So that's having an impact in terms of consumer spending ability. And shelter costs, which have been a key headwind to the Federal Reserve. It's been one of those more sticky components in the inflation basket that moderated as well. But it's still quite a strong component of the index. It's 4.2%, down from 4.4% in the previous month. So it's still adding upward pressure, and it's above that 2% target, which the Federal Reserve are really trying to achieve here. If we take the month in isolation, what we saw was inflation increase by 0.2% over the course of the month. So 2.8 over the year, but on the month 0.2%. And this compares to the previous read, which we highlighted, of 0.5%. If it had persisted at 0.5%, the Federal Reserve would have had a real problem, because that would have challenged their ability to bring inflation back down towards 2%. So a read of 0.2% is actually quite encouraging. If we strip out food and energy prices, what we saw is the core reading. Now, the core reading is really important. This is what the Federal Reserve tend to focus a little bit more on, because it's got less volatility than the energy and the food components within there. Core inflation has been above the target, but what we saw in February was core inflation year over year moderate to 3.1%, and that's the lowest reading which we've seen in the core basket for over 4 years. So that's quite encouraging. It's down from 3.3% in the previous month. And encouragingly, that month-over-month rate, so the month of February in isolation, that too increased by just 0.2%, down from the previous month's read of 0.4%. So in aggregate, what we're seeing is some of those inflationary pressures have just eased back a little bit in the February report. The initial reaction from bond markets was actually quite muted. You know, they're looking at a number of the components which are cooling. The market is still of the view that we could see as many as 2 or even 3 0.25% interest rate cuts in the US between now and the end of the year. But if we look further out, expectations of inflation are still a little bit blurred, and they're blurred mainly by the fact that there's a bit of uncertainty around the tariffs which are likely to be applied on international countries outside of the US and the retaliation effects in which they'll feel. In that context, what we did see today, or yesterday I should say, was the Bank of Canada, who reduced their interest rates by 0.25%. So interest rates in Canada now 2.75%. This wasn't a surprise, it was expected. The governor of the Bank of Canada had flagged that the economy in Canada has been ticking along quite well, quite healthily, and that's been supported by some of the interest rate cuts which they've put through over the last 12 months. But as they look ahead, recognising that they may see things slow down a little bit as they face themselves higher costs on their exports, and in retaliation, the tariffs in which they've applied back on the states, higher costs of their imports as well. So in aggregate, slightly more encouraging news on the inflation front, broadly quite well digested by the bond market overall. Thank you for watching.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.